Many small businesses end up paying far more tax than they actually need to, not because tax laws are unfair, but because of avoidable mistakes. In fact, many entrepreneurs focus heavily on growing their revenue and serving customers, but they rarely spend enough time understanding how taxation works for their business. As a result, they unknowingly create financial inefficiencies that cost them thousands over time. In this video, I will walk you through 5 common tax mistakes that small business owners make. More importantly, I will explain why these mistakes happen and how understanding a few simple principles can help you avoid them. Before we look at the mistakes, it's important to understand one key idea. Tax systems are not designed to punish businesses. In most countries, tax rules are structured around the concept of taxing real economic profit. That means businesses are allowed to deduct legitimate expenses that are necessary to operate. However, when business owners misunderstand these rules, they either fail to claim deductions or accidentally claim expenses that are not allowed. Both situations can create serious problems. The first common mistake is mixing personal expenses with business expenses. This happens very often in small businesses, especially when the owner manages the finances personally without clear separation between personal and company spending. When personal expenses are recorded as business costs, accounting records become inaccurate. For example, imagine a business owner purchasing personal items but recording them as business expense. In accounting terms, this reduces reported profit, but tax authorities review these transactions carefully. If they determine that the expenses were not genuinely related to the business, those expenses will be disallowed. That means they are added back to profit, increasing taxable income. The second mistake is poor record keeping. Many entrepreneurs underestimate how important financial documentation is. Receipts, invoices, and transaction records may seem minor, but they form the foundation of proper accounting. Without proper documentation, businesses often lose legitimate tax deductions. Imagine paying for office equipment, travel expenses, or professional services, but failing to keep supporting records. If these records are missing, it becomes difficult to justify the expense during a tax review. Good record keeping not only protects businesses during compliance checks, but it also helps owners understand their financial performance more clearly. The third mistake is misunderstanding taxable profit. Many business owners assume tax is calculated directly on revenue. But that is not how business taxation works. Tax is calculated on taxable profit, not total revenue. Profit is determined by subtracting allowable expenses from income. Then, additional adjustments may be applied according to tax rules. For example, some accounting expenses may not be deductible for tax purposes, while certain investments may qualify for tax allowances. These adjustments change the final taxable profit figure. The fourth mistake is ignoring tax planning altogether. Many business owners only think about taxes at the end of the year when filing returns. But effective businesses consider tax implications before making financial decisions. For example, investment timing, financing structure, and compensation strategies can all influence the final tax outcome. When businesses plan ahead, they can often improve cash flow and reduce unnecessary tax burdens within the boundaries of the law. The fifth common mistake is missing tax deadlines or compliance requirements. Late filings or missed tax payments can trigger penalties and interest charges. Over time, these additional costs accumulate and reduce business profitability. More importantly, repeated compliance failures can attract increased scrutiny from tax authorities. When we look at these mistakes together, a pattern becomes clear. Most tax problems are not caused by complex regulations, but by a lack of financial awareness. Businesses that maintain accurate records, understand profit calculation, and plan ahead for tax obligations usually operate far more efficiently. So, the real lesson here is simple. Understanding the fundamentals of taxation is not just about compliance, it's about making better business decisions. When entrepreneurs understand how tax systems interact with accounting and financial planning, they gain a clearer view of their company's true financial health. If you found this explanation useful, subscribe for more clear breakdowns of business, finance, and taxation.